Hey there, welcome to the channel. So today was kind of a little bit of a bloodbath in the market. All right, so what's interesting is in the market today is we really got hit with earnings. Target just got destroyed, down nearly 25%. I mean, look at that chart. I think just blew up. And then you look at stocks like, let's see, Walmart. Walmart just got beat up again. It had got beaten up the day before. And then, yeah, so definitely the retailers getting beat up. So I guess they reported their earnings and their profit dropped. And, the concern is that, they're struggling with their fuel and shipping costs and basically inflation. See, the thing is, the inflation affects people, but also affects corporations. And what happened in the earlier part of this inflation that we started in is many companies actually tried to absorb the increased cost. So basically, if the shipping was going up for them, or the cost of fuel, or the cost of the products they're selling, they were trying to absorb that because they didn't want to lose the sales. So what they would do is say, well, okay, look, I'll try to absorb the cost. I'll take a little less profit, whatever. But now they're to the point where they're forced to raise prices, and they're getting to the point where they're going to need to raise prices to a point where it's going to start to affect sales. And also the other problem is that it's really starting to crush their margin. And this is sort of a bigger picture with the inflation that's going on. Look, it's there's a lot of things, a lot of misconceptions about inflation. I mean, the simple fact is, what happened was, after the surveillance of sickness, what happened was the government printed a bunch of money, gave everyone stimmy checks. They gave it to people that were going to spend the money. When you look at the M2 money supply, and even after the M2 money supply is still growing right now. And if you look at it, it's just growing like a rocket. And so basically, if you have too many dollars chasing too few goods, you get inflation. Prices go up. And here's the thing: in the early part of the inflation, what happens? In the early part, people have money, money's invested, and you get these wonderful asset bubbles. Here we go, the stock price going up. But then at some point, um, basically, it starts affecting and crushing the asset bubbles as well. So what's happening here, the thing is to understand is no one wins, right? So you can't just go to like a Target or a Walmart and say, hey, you got to cut your prices. You're the reason for inflation. No, they can't do that because the cost that they're being charged for everything is going up. So then you go to their supplier and say, look, you have to cut the cost. And they're like, well, I can't cut the cost because my costs went up. And then you go to their supplier, and you go to their supplier, and then you go to the raw producer, you go to the farmer, you go to all the things, and just on down the line, and everyone's cost is going up. And the problem is, everyone's making less money as well. Everyone's profit is going down. See, if it was really that simple, that in an inflationary environment, that companies could just raise their prices without there being any kind of a negative effect, loss of sales, loss of income, and loss of profit, they would just do that. But they can't do that. And so finally, when you see a chart like this, Target, basically the hens have come home to roost. We've just gotten to the point where you can't have something for nothing. All those years, and this is many years of printing money, and the Fed, I mean, look, a couple of years ago, the Fed was like, we're really struggling to get to our 2% inflation rate. They had the rates from the 09 crisis out until they did do some rate rising in 2015. But before that, they were like, we can't get our 2% inflation. They just left the rates at zero forever. They quantitative easing, did all this crap, and they just couldn't get the inflation that they wanted. Now they got too much of it. And that's, an old saying, when it rains, it pours. But so now this is significant this week from the perspective that, yes, we're in a bear market. We're in a bear market. You can see on the indices that, you can make the argument we're still kind of transitioning, but we're really in it. And when, you hit the retailers and you hit the retail sales, which didn't drop a lot, but the problem with the retail sale numbers, it's not a volume or unit type thing. So if, for example, retail sales went up, 0.5% or 0.2%, that doesn't mean people actually bought more stuff. It may have mean that they bought less stuff, but the stuff costs more. There's no way really to distinguish that for those measures. So, yeah. so that's what I see. So actually another bad day in the market. An interesting thing, I look at this and, I had some puts on some time ago and I made some money on it. But one of the things, if you're in the camp and you're like, you want to try to make money on the market going down, the one thing to keep in mind is your implied volatility on those puts. So if you were to buy puts, right now the implied volatility is going to be very expensive. And so what can happen? Let's take an example. And this has happened to me and I've lived through this. So I've made so many mistakes in my life. But for example, let's say I bought a $400 put and I got a target at 360. Now this is significantly out. And this is something that, especially a lot of new option traders might do because they're like, well, I can't pay $100 for an option. So, I'll pay $5 for an option, right? And okay, fine. So you pick one that's out of the money. But the thing is, you're paying so much for it. What can happen and does happen if you're overpaying for it, even though the price moves down and all of a sudden you're in the money and you're like, hey, so let's say you bought a put. So you do a buy a put. I'll do more on this later, but you buy a put up here and with a target price down here and your target price, and you actually go through. And so now you're actually in the money. But the problem is what you may find is that the value of your option may still be going down. So at the same time that the option is moving into the money, if you were to plot the price of your option, let's say you bought it here, your option price is going down, which is exactly sort of the inverse thing. And the question is, why is that happening? Is it can happen in this because right now you're overpaying for that put. And one of the ways that you can tell this is like, look, you can't buy puts after, significant down moves, because what will happen is, and one of the things you can do is look at the VIX to get an idea. And you also have to look at the specific options that you're considering buying, because if you look at those and you see like a high implied volatility, you're really overpaying for it. So you can see that the VIX is on the elevated side of things. It's in the 30s. Now, I wouldn't say VIX could go higher for sure. Like, right, we're over here in this range. VIX has spiked into 85s, getting near to 100 on a few, but they're like quick moments in time, right? So that's one of the risks. And so you have to be careful. The other thing that if you were looking for the downside, SQQQ, this is going to be one of those inverse traded funds. But keep in mind, look at this curve, okay? This is an inverse of the Qs. And this is actually an Ultra Pro. I'm not sure how many times, but usually the Ultra Pro are like a 2x, some are like a 3x, but it's probably like a 2x inverse. So the thing that's happening here to kind of keep in mind is that, yes, the reason this thing has gone to essentially zero is that the Qs have essentially, had one heck of a run through this time. So the Qs have been going up like this, right? So the Qs are going up like that, okay? And this is going down. But one of the things to note is this is going down more than just due to the Qs, right? It's going down much more than that. In other words, this SQQ has a negative carry. In other words, if you go look at the stuff for that, you might see like a 2% fee kind of a thing, or costs are 2%. But in addition, there's not only that, there's the cost, because when you actually look at some of these things, you'll see that their assets are just very often a swap. It'll be like whatever they have for assets. Now, I'm not saying for this one, I'm saying in general, I've looked at these before, and you go and you look at them, you're like, okay, they have $10 billion and they have $9 billion swap, which means it's exactly like the Big Short movie. It's exactly kind of a credit default swap. But this case is a little different. It's just an index swap. And so it's written against a big bank or someone that supplies that. So that would be Goldman Sachs, JP Morgan, or whoever. And so the point is that costs money to keep carrying it and keep carrying it. So the point is, if you're in a situation and the market goes down, let's say the market goes down 10%. So the market goes down 10%. And you would think, well, if I have a 2x negative, then I should go up 20%, right? Well, you're not going to. You're not going to. Now, maybe you'll get 15% in a short term. Maybe you'll get that. But the thing is, if you hold that longer, In other words, you have to be really strategic and really, you have to be really like a super trader at it, because the problem is you are in a situation where if you have to sit around 3 or 4 months in it, you're just losing. And that's exactly what's happening in options. Your options, as they go on in time, you're losing your extrinsic value. So that's why, if in my previous example where you bought a put and you way overpaid for it, that even though it may, the price of the security underneath may actually move in your direction, actually move into the money, but you overpaid so much, you're losing the extrinsic value. And you lose that over time to the point where you get to intrinsic, which is the actual value of the option based on the price. So those are some things to be careful of. So, if you haven't done it, then don't do it. What you want to do is, I think, and this is not financial advice, this is what I'm doing, because I've gotten burnt. I've gotten burnt sometimes. Let me tell you, back in the original financial crisis and housing crisis, I hit a bunch of the builders for puts, and I hit them really good. And I remember my account was I had a couple $100,000 account, something like that. And I'm talking like I had like a week, or I had a couple days, like I hit 50, 60,000 positive. And I was smart enough to take the money. I'm like, okay, take the money. But the problem is I kept going back in. I like, okay, well, now I let this thing burn off, like kind of do dead cat bounce. I'm gonna get back in, but I was doing it wrong. And it was just a situation where what's going on is like, okay, they're still overvalued. I'm still buying at a very expensive implied volatility. And and after a crash like that, the volatility goes away. And that's what you would see. Like, you very often see that. And this is where we talk about basing. Like, at some point, this thing will stop going down and it'll be basing. But during this basing time, where no one's winning, right? The bulls can't get it out to the upside, and the shorts can't get it down. But during that time, even all your puts in your cars, puts and calls during that time, what's going on? The value is dropping, right? So the value is dropping because the volatility is drying up. So that extrinsic value is decaying over time. So, usually that's where everyone loses money on options, and you can lose that as well on the inverse funds. So really, just, I would strongly advise that it's not financial advice, but I strongly advise that, really be careful with that stuff. Because, for example, if you're in this situation and you realize over here that, hey, things are going wrong and things are getting messed up, and you're like, okay, well, I've been in this thing and it's profits. Well, let me back off. Let me take profits. Let me cut back on the speculative positions. And once you start cutting these major moving averages, your 200-day or 50-week, you start cutting into these things, you start have to asking really questions, and then looking what the Fed's doing the whole thing. Why not lock that in? And now the question is, well, okay, do I get in here? No, you don't get in here. You're looking for exactly what you saw before, right? And so this gets really hard, because the problem is that it's so, like, I'm looking at a 20-year chart, and so I'm trying to explain to you, like, well, where's a good example of how to get back in? These are very short, and it could be that the market has changed. And that's the other thing that's really hard to get a handle on, because over here with this Cerveza thing, like in here, it just really just came in really and out really quick. And then this one was more of like a base in here. But more traditionally in 09, you had a much more longer basing, year and a half long basing. In 03, you had 02. It took a year or two for this thing to base before your next move. And I know that these look like rounding errors, but these are big moves. This was like a 50% down move. This is 100% move up, 50 down, 100 move, and then you're on to this other move here. So, these are big moves. So, yeah, I don't know what to say about that. I think that, as long as you're still in the downward trend, you don't have really anything to hang your hat on, and you need some kind of a base to hang your hat on. And that's where it's like a good thing to be looking at, doing like fundamental analysis on companies. Hey, if you're thinking like a Tesla car dealership, whatever, the new guys, hey, are any of these going to make it? This is a great example to kind of try to figure out if they can. Some of these more modern bases are really hard. Here, everything was okay over here. and then you broke here, you came down. But what is an interesting thing is you started to come back up. Here's really your big high. And as you just kind of look how you see how you had this hiccup day week actually, and then you started to come up and then down, and then over here you really seal your fate, right? Because now this has now become support. So now you're back above a previous high, and even though you're not really worked out much of this, you're really on your way. Now the 2020, this is really unique because this is just, they've never printed that much money before. I don't think they've ever done that. And the question is, are they going to do that again? And the answer is they very well might. And if they do that, I mean, it's going to be a huge problem because look, he's got to get that inflation down. I mean, he might as well just crank the rates by 5% on Saturday. He should just do a Saturday Night Massacre kind of thing and just be like, hey, dude, I'm just going to crank rates by 5-6% on Saturday, get it over with. The market will just cut in half, and then everyone will adjust out. The inflation will start coming off within a matter of a couple quarters. We'll be in a recession, and it'll be over. And then we could just, you'll see the market just base out and move on. All right, well, those are my thoughts for this one. Remember, not financial advice. And just, if you're sitting there and you're in that situation where you're concerned, don't go chasing to the downside. And just really careful with that stuff because you just get burnt. And the worst part of it is you can be right. Like on options, you can be right about the direction, but if you're off by the timing, even by a couple weeks, like boom, you lose. So just be careful with that one. Talk to you. Bye.